Welcome back. Let's talk about the economy now because we have several things lined up. There's, of course, the election results. Then there's a full-blown budget that we'll have in July. In the middle, there is an RBI policy as well. Pranjul Bhandari, the chief India economist at HSBC, joins in now. Pranjul, she's here with me in the studio, by the way. She's based in Singapore, but she's in India now. So, Pranjul, thank you so much for, first of all, coming here to the studio at a very important time, right, for the economy. We're heading into a big event. It could be a binary event for the market and the economy, but how are you positioned in general and what is your expectation from the budget in July?
Okay, great. So look, good to be here in the studio. So I think in terms of growth, I think India is in a pretty resilient place. Our growth is pretty robust. On Friday, we are going to get the GDP data for the March quarter, and my sense is generally activity in this quarter has actually been better than in the previous quarter. You know, all the PMIs are higher, the construction sector has taken off. It's not just public capex, but it's also real estate capex. Construction creates a lot of jobs in rural India. Rural incomes have started to do a little better than before. And then we've got the RBI dividend, which makes the fiscal consolidation a little less painful on growth. So all of this is coming together, and I think we're in a good place in terms of growth. So, you know, I'm excited for the big events that are coming up. I think India is entering on a place of strength. Okay, so
you're saying growth is robust, real estate capex has taken off and things are looking good, right? Now, what this market wants is continuity of policy and a smooth transition as well of the new government. The expectation is that the current government will come back to power and then policy continuity is something that one can expect. But what are you looking at? Apart from growth, what are the 2 or 3 things that the government can do now to strengthen the economy further?
Yeah, so I think the reforms that the government articulates in its first 100 days or so is going to be extremely important for the medium-term growth of the economy. And here I sort of break it down a bit too simplistically into easy reforms and hard reforms. Easy reforms, although they're not that easy, are things that the government has already been doing well and just doing more of that. For example, attracting investment in futuristic sectors. You know, we had Apple, we're getting semiconductors, perhaps EVs. So a bunch of, that, continuing with public capex, ensuring that macro stability is intact, getting some disinvestments done. I think if all of this continues, then we're like a 6.5% GDP growth economy in the medium term. But if we want to aim for more, 7.5% to 8%, which, by the way, we need for the kind of jobs we need to create in the next decade, then I think the government needs to take on much harder reforms. Land, labor, ease of doing business, farm laws. And my sense is we'll know in the next 100 days, what this government wants to really pursue. And the growth dividend would be either a 6.5% growth economy or a 7.5% to 8% growth economy.
So you said easy reforms like continuation of public capex is something that is perhaps a low-hanging fruit. But some of these harder reforms, land, labor, ease of doing business, is that something that you would expect could be taken up in the first 100 days itself? Or is that a tall ask given the way, the macroeconomic and the global situation is panning out?
Look, these are tough reforms, like farm. We've already had an experience with that in the past. For this, a lot of consensus has to be built. So I don't think, really getting these bills passed will happen very quickly, but we'll get to know if the government is really pursuing it, if they are starting the conversation, they're reaching out to stakeholders. I think that is something that will be clear in the next 100 days, if the government is actually interested in these reforms in a 2 to 3 year horizon.
Okay, that's about the government, right? I want to also ask you about the RBI's intention. What do you think could happen in the June policy? The expectation is that the rate cuts will be very slow, they will be very shallow. So realistically, what are you expecting?
A very interesting thing has happened in inflation. For the first time in the history of tracking the data for me, I'm seeing core inflation fall at a time growth is extremely robust. And I looked into it very carefully. How come core inflation has halved over the last year? And my sense is 3 things have played a very important role. Number 1, Chinese disinflation. China export prices are falling. India is importing many more consumer goods from China. And through that channel is actually importing some of this disinflation. I think this is a very important part. The second part is RBI being hawkish. Now look at this RBI. They were able to bring down inflation from 6.5 to 5, but instead of patting themselves in the back, they keep saying, oh, the job is not yet over, we need to get to 4. They keep sounding hawkish. That in itself is important for driving down inflation. And third is the commodity price fall. The fact that compared to 2022, in 2023, we saw oil prices, metal prices, and all of these prices fall. and manufacturers were able to cut prices. So I think all of this has brought down core inflation. Out of these, I think Chinese disinflation, RBI remaining hawkish will continue. But what I'm beginning to worry about, and I think a lot of people are not talking about it, is commodity prices. Year to date, commodity prices across commodities has risen by 11%. I think that's pretty high. And my sense is, given global demand has surprised on the upside, this is something that could continue and that would come in the way of the RBI really easing. Does the RBI really have to ease? Not really. Growth is robust. A little bit of easing can happen via liquidity. Remember, in June, July, once the government starts spending again, once we get all of these index-related bond flows coming in, liquidity will be looser. Some effective rate cut will happen from that route. So my sense is, putting all of this together, if we cut, we're going to cut minimally, not too much. We have the Fed forecast of Fed cuts of about, 1 this year, 3 next year, overall 4 rate cuts over a 1-year horizon. I think for every 4 rate cuts the Fed gives, I think RBI can cut by about 1 or maximum 2.
So in the June policy, at least, there's no expectation of a rate cut.
No.
In September, is that your base case?
My sense is no. I think we'll wait for the end of the year. Our Fed forecast is for the first Fed rate cut in September, and there's a lot of uncertainty even about that. So we'll see where that goes, what is the impact on the dollar, and I think the RBI will first start considering it in the fag end of 2024.
Okay. I wanted to come back to the economy just to understand what else can we expect, from post the election and from the budget, right? Where are we at in terms of a pickup in the capex cycle? You spoke about real estate capex picking up. Corporate capex, I think, are seeing some green shoots. How is the rural economy looking? What are some insights that you can share with us?
Yeah, so 2 points here. We got this RBI dividend, this big bounty of 2.1 trillion rupees. It's about 1.3 trillion higher than the government had estimated and budgeted. My sense is that they could split it between saving and spending. So about half of it they could use to lower the fiscal deficit and to lower the government borrowing, so by about 600 billion. But the other half it could use for welfare spending, and that's something to look forward to in the budget. When we had the interim budget in February, capex was well provisioned for, 17% year-on-year growth. That's a lot. You can't do more than that. You don't have implementation capacity on the ground. But what was under provisioned was welfare schemes. It was actually cut by 0.6% of GDP. So my sense is that we will provision for that a little more, and we could see a little more welfare schemes out there, which, by the way, will be great for consumption, for mass consumption, which indirectly will be good for capex. Now, coming to capex, public capex is great. We've been seeing that. But it's only 25% of overall capex. The big question is, when will the remainder, 75% private come? So there are 2 parts to it, domestic and foreign. Domestic is waiting for capacity utilization to rise, for mass consumption to rise, and if the government can have some welfare spending in its budget in July, then perhaps that will help, increase the prospect and improve the prospect of domestic capex. Foreign capex is a little more problematic. We all talk about nearshoring, reshoring, but if you look at the hard data, not too much has happened. Too much of manufacturing chains haven't yet moved. So we'll have to work harder. We'll have to do all of those reforms, ease of doing business, land, labor, if we want to get a lot more of the foreign capex to come in. But overall, if a little bit more focus on welfare spending, I think mass consumption will be better and we could start seeing some domestic capex pick up. Okay, so the focus is on welfare spending and hopefully that will help pick up mass consumption. Pranjul, thank you so much for joining us here, coming to the studio, and we have big events upon us, so we'll try and touch base with you once those events are out of the way. Well,